Welcome to Crescat's live market call featuring our macro and activist mining research. I'm Kevin Smith, Crescat's founder and chief investment officer. Before we get started, please refer to our important disclosures page on the screen now. These disclosures can also be found in the description on Crescat's YouTube channel and on our website. Crescat's live market call is about sharing timely macro and newsworthy geologic updates, both positive and negative news across our holdings as they arise. These videos represent the opinions of Crescat as a mining and exploration industry advocate. Our objective is to share the overall geologic progress on our activist strategy in creating new economic metal deposits in viable mining jurisdictions around the world. If you enjoy these videos, please click on the like button and make sure you're subscribed to our YouTube channel to get notified of upcoming episodes. You can also follow Crescat Capital on Twitter for ongoing macro research and important news updates on our activist metals positions. If you want to learn more about Crescat's investment strategies, we encourage you to reach out to Merrick Iwahashi. His contact information is on the screen now and can also be found on our website. So let's get started. So I'm just going to touch on this chart again real fast because we've showed it the past a few times, but we believe at Crescat, and we'll show additional supporting evidence that we are at a valuation top for the overall U.S. equity markets, and it's especially concentrated in the large cap growth stocks and the large cap tech stocks in particular. And this is just showing that double top in the enterprise value to GDP measure across the top 10 mega cap market cap stocks, and we really think that we are in the process of topping out here, and it's an important risk to consider when you're considering investing in the markets today. There's a lot of opportunity too, so it's nothing to be too afraid of if you are just looking at areas outside, especially of these top 10 mega caps. Let's go on to the next. So here's Ned Davis Research, and this chart was going around on Twitter, and look at what they're doing. They're also showing the largest 10 stocks in the market, which, other than Berkshire Hathaway, I think it's, they're all tech stocks. And so it's really the same 10 that we showed in our chart. And it's looking at the PE ratio, and showing that today the PE ratio of these largest 10 stocks are 2.6 standard deviations above the historic mean. And so while these PE multiples might have looked higher in 2021 when we had that little earlier market top and downturn in 2022, like our chart shows, we're back at new market highs, and the multiples are still really, really high, 2.6 standard deviations above the historic mean. Let's go on to the next. And I've shown this before. I'm showing it again, especially, because this quarter is the quarter where we have the fundamentals turning down into negative year-over-year comparisons in free cash flow. We're talking about growth turning to decline in free cash flow at Microsoft and Apple. These are the two largest market cap companies in the S&P 500 in the world, and the fundamentals are turning down in terms of their free cash flow. How can that be? I thought these were unstoppable growth companies that were going to grow forever, and their valuations are justified. Well, we're just looking at the data here. Now, Crescat, may or may not have positions. We're not making a recommendation long or short in either of these stocks or any of these stocks that we talk about today to the general public. But this is examples of the research that we do, and these are positions that we may or may not have in our short strategies, and we don't represent that we're going to continue to have them in the future either. If we might have them today, we're just showing you our research. And look at this divergence. Yesterday, we saw the Justice Department, go on to the next, Nathaniel, come out with a lawsuit that it's been working on for 5 years. Now they've just announced the lawsuit. They're suing Apple for antitrust. and accusing Apple of being a monopoly. Now, there is antitrust action going on in the U.S. with the Department of Justice, the Federal Trade Commission, and the European regulatory authorities across all of these mega cap tech stocks. And it's not just Apple that has a monopoly. It's Google that has a monopoly on search and advertising. It's Microsoft that has a monopoly on the Windows operating system and that marketplace. And so you're going to see more of this antitrust action creeping up, we believe, across all of these stocks, because they, like our top 10 market cap to GDP chart shows, these companies simply have too big of a share of the overall economy, too big a share of the overall economy's profit margins, as one of these next charts is going to show here. But first, let's look at this chart that Nathaniel, one of our analysts here, created. That's just looking at the mean percentile rank of 4 different valuation ratios for the S&P 500. We're looking at price to earnings ratios, price to cash flow ratios, enterprise value to sales, and price to book. And if you take the aggregate of all these different fundamental measures across the S&P and you average these 4 different valuation ratios, we are at historic peaks today that are no different than we were at the 2000 tech bubble top. We're not quite as high as we were at that 2021 recent intermediate market top. Of course, the S&P's gone to even new higher highs, but we're at historic valuation highs. This is an important risk that investors just need to understand and appreciate, especially index investors and passive investors in these mega cap growth stocks. There is a risk. We are a valuation risk. Let's go on to the next. And one of the things that we see is we have an unsustainable, we believe, we're coming off record high profit margins, but they're still the highest in the history of this data. This comes from the Robert Shiller data, which goes all the way at Yale. He's a professor there, an economics professor. This data goes all the way back to 1946. And you can see that in 2021, in the wake of COVID, we hit record profit margins for the S&P 500 in the wake of COVID, with all of the economic stimulus and the tax cuts, et cetera. We were at record profit margins. But what happens when you take record, we think, unsustainable profit margins, and unsustainable for a variety of reasons, including rising inflationary pressures. But when you take historically high valuation multiples and you stack those on top of historically high profit margins, which, even though they've come down from the 2021 peak, they're still at historically high levels. The problem that you get when you stack high valuation multiples and high profit margins is that this is the setup for a major economic downturn. As these metrics, start to get compressed because of rising inflation, rising cost pressures, a downturn in the economy, that's coming due to rising interest rates. Potentially, we think, it's not guaranteed, but this is our research. These are some of the views that we have. Let's go on to the next. Let's look at it in a completely different way. Here's some John Hussman data. John Hussman's a fund manager. He runs another fund, but he's a Stanford PhD. He has some incredible data. And here he's looking at the valuation. This is kind of a Warren Buffett style indicator that looks at total market cap to GDP. And except it's looking at non-financial, so it's excluding the financial sector, the banks, and it's just looking at the non-financial sector, and it's looking at a similar measure to GDP that's called gross value added. It's computed by the Bureau of Economic Analysis, and it's on all of the corporations across the U.S. that goes into the GDP data. It's looking at the basically the non-financial GDP of all U.S. corporations, and it's comparing it to the market cap of all of the public non-financial public stocks. It's kind of a Warren Buffett valuation indicator. If you read Warren Buffett's latest shareholder letter, you'll see that he's about the most bearish that he's ever been in his long career. He writes about it extensively in his shareholder letter, warning about the risks. He's still long, but he's warning about the risk and to not expect high returns. Well, it's because we're at record valuations. But what happens when you come off of these record valuations? The last times we've seen this were the peak of the tech bubble and right ahead of that tech bubble recession, and in 1929. So, do you think that people saw this coming, in 2000 or in 1929? I mean, no. I mean, it was the Roaring '20s. Everyone was making money in the stock market. We had in 2000 we had it was the internet and everything, and the .com, and everything was great, fantastic. Everyone was fully employed. But what happens when the economy starts to turn down, profit margins start to turn down, and stocks go into a correction from a bubble? What happens is you get a recession and things change. And so, no, by definition, the masses do not see it coming. The masses are fully invested. Everyone's long, and that's the type of sentiment that we have today. Let's go on to the next. So this is showing. This is a 3D chart, so it might be a little complicated to try to conceive, but it's all the information is here, and so it's looking at three different axes. We're looking at PE, operating PE multiples, okay, for the S&P 500 stocks on one of those x-axes, and on that other one that curves off, that splits off there on the far right, we're looking at operating margins. So these are a couple of the things that we have shown here, right? Record profit margins on top of record multiples. And this is the combination for major market tops ahead of recession, because these things are just unsustainable. So what does this show? This is looking at 10-year periods of subsequent returns. So we're going all the way back to 1990 in this case. That's looking at monthly. What's looking at 10-year subsequent returns for when we've had each of these dot plots on this chart. Each of those dots representing, on one dimension, the PE ratios, and on the other dimension, operating earnings. And you can see that when you have high PE ratios and high operating margins, you have subsequent 10-year returns in the S&P 500 that are negative. And see that green dot on there? That is where we are today on this chart of the combination of S&P PE multiples and S&P operating margins. Now, keep in mind that these are aggregate statistics, and these measures are a little bit skewed by this mega cap growth phenomenon that we have, and the weightings of those things. There are a number of stocks in the market at large and in certain industries that are actually pretty cheap today, and do not represent this overall market bubble, like stocks in the mining industry and in the oil and gas industry. But let's go on to the next. So no one in the world thinks we're going to have a recession right now. I mean, everyone seems to think that it's a soft landing at worst, and that it's just full steam ahead. The Fed just told us that their economic growth projections are increasing. But look at this model from the New York Fed, which looks at yield curve, which looks at the inversions in the yield curve to forecast what they call the probability of a recession. And you can see that based on yield curve inversions and this high probability of recession, and every time we've been at this high level of probability of recession based on an inverted yield curve, we've actually had a pretty serious recession. And some of the more serious ones, like the 1973-74 stagflationary recession, when large cap growth stocks came down at the same time as commodities, and commodity stocks went up. Similarly in the late 80s, that 2000s, that early 2000s recession, when it was a tech bust, and we also had the beginning of a commodity bull market, and gold and silver stocks went up along with energy stocks at the same time as large cap growth stocks were decimated over a couple year period. So let's go on to the next. So one of the things that we look at in a trade that we may or may not have on in our global macro fund is this yield curve steepener trade. So what the heck is that? Well, it's a trade that looks at, taking a short position on the 30-year Treasury bond combined with a duration matched long position in the 2-year Treasury yield. So what's this looking at? It's looking at the difference between the yield on 30-year Treasuries and on 2-year Treasuries. And you can see that the yield curve is still inverted, about 20 basis points on this measure. But look, we're coming off of that minus 100 basis point inversion. And what do you notice in this chart if you compare it to other recessions like 2001, 2008, even the COVID recession, and as brief as it was in 2020, that when you're going into the recession is that when the yields normalize. Normally because of the risk premium, normally the term premium, as it's called, a long-term Treasury bond will yield more than a short-term Treasury bond. But what's been going on? The Fed's been hiking interest rates. Now we have inverted yield curves. It's a record long period of yield curve inversion, by the way, ahead of a recession. So yield curve steepener trade, something that looks pretty interesting to us today. Let's go on to the next. This is looking at the embedded 1-year break-even inflation expectations that are priced into the 1-year Treasury bill, and the TIPS market for 1-year Treasuries. What do you notice? What you notice is that inflation expectations at the short end of things have continued to rise all year, but what did we hear from the Fed earlier this week? We heard from the Fed that they're still planning to lower interest rates 3 times before the end of this year. Well, guess what happened on that same day? That was the day where we saw gold and gold stocks and silver really start to move up substantially. That was a great day for Crescat and our positioning. This is the problem is that we continue to see sticky inflation expectations, and the whole goal of all these interest rate hikes and the yield curve inversions that we see now was to get inflation under control. But we have a theory that inflation is really not going to be under control. We have many reasons for that, and we think it portends a major commodity bull market cycle ahead. That's how we're positioned today at Crescat, is for that. Let's go on to the next. And people say, well, Kevin, you're so bearish on large cap tech stocks and the S&P 500, but how can you also be bullish on commodities at the same time? Everyone, there's so many people, not everyone, but it seems like everyone has this recency bias and is so afraid that it's going to be 2008 again. We call it fighting the last war. But we have proof from history, real historic data that shows that there are times, like in the early 2000s, 2001 and 2002, where you can have gold and silver going up. You can have gold and silver mining stocks going up. You can have oil and gas stocks going up and commodity prices going up at the same time as you have a correction in stock prices in ridiculously overvalued, hyped up large cap growth in technology stocks. It happened in the tech bust in the 2000s. It can happen again. Are we guaranteeing that it's going to happen again? No, but we have a lot of evidence of why we think that it can, and we personally believe that it will, and that happens to be how we're positioned today in across our firm. There's another period where this happened too. It didn't just happen in well, by the way, this was when gold stocks went up fivefold, ahead of the global financial crisis, in the wake of the tech bust, at the same time as tech stocks continued to be down over that entire period. Let's go on to the next. That 1973-74 recession, I know I've shown this, a million times, but I'm going to keep showing it because we think it's all still ahead of us. And here we are. Yeah, we think we're at that "you are here" place. Are we guaranteed to be at that place? No, we've said we were here before, and we haven't really seen this all unfold yet. But it just continues to coil up and be ripe to unfold. We think it's starting to unfold with gold breaking out, with silver breaking out. Quinton's going to have a lot to talk about silver. Tavi's going to be talking about silver today too. So it's going to be a big silver day to look forward to, especially as we get to Quinton's part of the talk coming up here. But this just shows that gold stocks went up fivefold in 1973 and 74 at the same time as tech stocks. And the S&P 500 went down substantially. S&P 500 went down 50%. The Nifty 50 large cap growth in technology stocks went down more like 80 to 90%. I'm not kidding. Look it up. We're going to turn it over to Tavi. Tavi had to pre-record his session today, so he's going to be going next, and then we'll get on to Quinton. So take it away, Tavi.
All right. Hi, everyone. This is Tavi Costa from Switzerland. We're at the Swiss Mining Institute for this week, and we'll be sharing with you some of my views for this Friday Live. And I've been in the works of writing a research letter, a long research letter, in which we'll be talking more about one of the main topics of this research would be regarding what I think it's really the end of a highly financially globalized environment. I believe that deglobalization is right at the core of a lot of the problems we have in the global economy today. And with that, we're seeing central banks being forced to own a neutral asset like gold. And more importantly, we're also seeing this exponential growth of debt across most economies, especially developed economies. And in fact, if you look at the white line in this chart, which is really looking at the foreign holdings of U.S. Treasuries as a percentage of overall government debt, they're not net sellers of those securities. But what they're doing is we're actually seeing a surge of those issuances that are not being accompanied by a large buyer. Instead, we're seeing the blue line, which is showing the accumulation of gold of most of the foreign central banks, particularly the Eastern central banks are the ones really driving this, which ultimately I think it's going to happen across other economies as well in the Western societies as too. But really what's happening is we're just at the beginning of that transition towards gold, in my view. And this is so important because we're yet to see the general investor, the 60-40 portfolios follow that lead and causing this full transition of I always talk about the two poles of capital. There's the 60-40 portfolios that are mostly have a prioritization towards volatility when they think about that 40% side of their allocation, and that usually when gold is now becoming less volatile than treasuries, it certainly brings the attention to the potential of that asset becoming at least receiving some of those flows from U.S. Treasuries that have been so volatile and really a money-losing investment strategy over the last 2 to 3 years. And the other side has been central banks. They have a different prioritization. For them, it's all about improving the quality of their international reserves. And we're seeing more and more that transition towards the metal. And I think this is just the beginning of what's going to continue to drive gold moving forward. Now, this letter has a different focus on something else that I've been noticing for some time now. It's been of our views that because of deglobalization, again, at its core, it is also causing some disagreements among nations and creating an important need for a lot of those countries to start relying on their own operations, meaning starting to really rebuild their economies. And in case of the U.S. specifically, we're seeing a degree of construction spending that we haven't seen in many years. I should say maybe even in centuries, not even decades. In fact, if you go back, this research letter will talk a little bit more about what the last time we've had a manufacturing revamp, or I should say an infrastructure revamp in the U.S., which was 1956 with President Eisenhower that passed the Highway Act, in which authorized the government to spend close to $25 billion, which in today's dollars would be close to $200 billion. And to put into perspective, in 2021, we passed the Infrastructure Act here recently, in which was about 1.2 trillion, that amount. So, certainly, as this chart shows, you have CapEx in a declining trend for producers. If we're going to be building more, we're going to need materials. And so that's the idea, is that the CapEx trend, it really acts as a lagging effect. It takes some time for us to see the spending really translating to higher supply for natural resources. You have to first explore, and then you have to develop. The developing phase it goes through the permitting, the engineering, the construction side, until you actually get to production level. And therefore, that lagging effect, along with the demand for construction and the need for reshoring, is really what has been driving this red line. And we believe it's just the beginning. We're going to see a lot more. In fact, recently we've had those CEOs of technology companies really talking about the need for data centers and so forth, and some of them throwing numbers that we're going to be spending close to $5 to $7 trillion to build those data centers, which it sounds like insanity to me. But even if 10% of that gets spent, it still is a very significant amount, and much larger than we've seen in many periods in the past. And the irony here is that, yes, AI is highly deflationary, but to get to a deflationary aspect, first, we need to build. And as we build, it actually creates inflation first. And so that's the interesting part. This is a letter from Bank of America looking at real assets versus financial assets. And you can see real assets, we actually look at commodities, real estates, and collectibles. And then financial assets looking at stocks and long-term government bonds since 1925. And you can see this ups and downs, very cyclical and secularly cyclical as well. And today we're at the lowest level in history. That, to me, is the opportunity, is to buy real assets, hard assets. And our niche has been more in metals and mining, because the duration of metals and mining takes a lot longer for you to really adjust the supply side of those commodities, given just the duration of the business itself, relative to, let's say, agricultural commodities per se. And so note in this chart as well how real assets actually also outperform financial assets in 1940s and the 1970s. And that really is something that we think it's going to be very pronounced today, given the fact that we're not only seeing an infrastructure rebuild across many economies, but also we're seeing the inflation trends being very highly embedded in the economy. And I think there's a fifth pillar of inflation that we'll refer to here. And I also find it fascinating how perhaps the Fed is being very political. How in the world can they communicate such a dovish message with inflation expectations falling, meaning loosening monetary conditions? Loosening monetary conditions, inflation expectations actually rising, as this chart shows. So we're seeing signs of the potential of a second wave of inflation. And even with that, the Fed is choosing to look at the unemployment, or I should say the labor market data, which is starting to show some deterioration, and therefore, perhaps justifying that message of being more dovish. In my view, if this is the case, where we're going to see inflation expectation rising, financial conditions easing, and the Fed justifying their actions to ease even further conditions through reducing interest rates, I can't think of a better time to own hard assets than today. And then I looked at money supply and relative to the trend, the historical trend we're seeing here, and you can see here, despite the fact that money supply has declined recently, it still is well above its historical trend. This is a chart from Double Line Capital, by the way, but I thought this was a really interesting chart that also shows, how much we're off from that pre-pandemic trend today, and perhaps why inflation has been so sticky as well. The fifth pillar that I often talk about, which ones are the pillars before? Well, deglobalization is one, reckless amount of fiscal spending, the labor markets with this kind of wage prices spiral similar to the 1970s, and the chronic underinvestments in natural resource industries. Now I think there's a fifth one, and the fifth one is this increasing population, mostly being caused by immigration, illegal immigration in the U.S. In our view, this is going to cause a large increase of shelter cost, and therefore it's going to also drive. It's the largest component of CPI, and will probably be one of the ramifications from this increase in the population in the U.S. And then the other thing that it's important to know here is what's happening with the U.S. monetary base. U.S. monetary base has been on an upward trend here recently, which it resembles other periods since the global financial crisis era, when we had a QE1, QE2, and QE3, and then we've had the COVID stimulus. And central banks are kind of acting in a way where they're really addicted to those problems. Every time we see a problem emerging in the economy, we immediately that is immediately met with a liquidity injection, and that is certainly the case today. Since the banks are starting having issues, we like to call this not QE, but the monetary base itself is in an upward trajectory. And not only that, if you look at the PBOC balance sheet, it's up about $850 billion since August of last year. And those are all, this is really a global phenomenon. I think it's no surprise for most people that China is facing a real debt crisis, and now we're seeing that on the back of that, it's actually creating a real monetary dilution problem, which might create even a monetary crisis as well in their country. What is important here? It's a chart that is the data is provided by Increment and AG from my friend Ronnie Sterfolet, and you can see in this chart is such a good perspective of history and showing how commodities work through history. And you can see here that there are really two times in history that commodities do very well. It's inflationary cycles, and it's during manufacturing booms. And I think we're going to have both this time. I think we're at the early stages of an inflationary era, and on top of it, I think the G7 economies are in the works in terms of this manufacturing revamp as well. That is likely to cause a upward demand for materials overall. And then more importantly, when you think about expressing that view, then silver production or silver itself comes to mind. And the supply case for silver is just as strong as the demand side. And here you're looking at two of the largest producers of silver in the world. China is also a large producer, but those two combined are by far the largest in the world. And you can see here that on the 12-month moving average, the production for those two countries is down about 25% from its peak levels, and it's about the lowest levels since in 14 years, essentially. So production is being reduced over the years, and so supply is to me looking more and more constrained. At the same time, we're seeing silver actually reacting in a very bullish way. If you just look at the technical setup here for the quarterly candles of silver, we just broke out. We just broke out from a major trend. If you go back further, this is to me an indication or a suggestion that we're probably very likely to see new highs for silver prices as this technical breakout really develops itself over time. And so, to me, this is incredibly bullish for the overall industry. It's almost, to me, it's insane to see the gold to silver ratio close to 90 still. It's in my view a great opportunity, and so therefore why we focus so much on silver related assets. And maybe a great roadmap for all this is just silver in yen terms, just like gold in yen terms was surging way before gold in USD terms. Here's silver in yen terms about to retest their 2011 highs, and the white line, which is silver in US dollars, is yet to start moving. And interestingly, here's the GLD ETF. I love this chart just to understand the gold market overall, because assets under management for GLD are declining. They're not increasing, which suggests that who has been buying this or who has been buying gold itself, because this white line, the GLD ETF, is designed to follow gold prices. So who has been buying this really is central banks. And so if central banks are buying gold, therefore, one of the reasons as well we're not seeing the flows coming into the miners, because the miners are not in usually a place or an investment vehicle that central banks usually purchase. And so we need to see yet the general investor come into the space. And usually, historically, what we tend to see is large institutions start their trend and then others follow. So we believe that that's going to be the case here, and therefore why we've been building a high quality, what we believe to be a high quality number of companies that we own in our portfolio. So here's the miners to gold ratio. By the way, this we like to always try to claim that what's happening today is unprecedented, but it's not unprecedented. This type of underperformance by the miners relative to gold happened in the 70s too, in the early 70s. And so in our view, this is, we've been through a real distress environment for the mining industry. And what is the catalyst? What is the catalyst to change here? The catalyst is gold prices. The catalyst is gold actually entering a bull market. The catalyst as well is really confirming that we are in an inflationary era. Inflationary periods, and owning miners or running a mining company is one of the most difficult tasks one can be asked to do. And it's not only capital intensive, it's so many possibilities of things that could go wrong. And so that usually reflects on the cyclicality of this industry. Now, there are some decades you want to own those industries, and those decades are usually aligned with inflation trends. And if you are entering a long-term inflationary era, which we believe is the case given all these strong pillars of inflation developing in the economy, it gives me a conviction to start allocating capital into what I believe to be actually the most disliked industry in the markets today. It's certainly the miners. And look, when gold starts moving, it really lifts all boats. Historically, you can say that there's a volatility aspect to silver and copper that is different than gold, and certainly true. Volatility is actually quite different between among those metals. But if you think about the overall trend, is actually also very similar. And so you can see here that when gold starts moving, then silver and copper also move along the way. In fact, they tend to lead gold to the upside. And by the way, if this is indeed a bull market in gold, which I believe it is, because of what central banks are doing, because of how trapped they are, fundamentally speaking, I would say that the opportunity is even higher in other things that have to usually lead in a gold market, which is silver, which is other precious metals, even copper as well, which is a base metal, but also the miners. And the miners are the ones that are really distressed in this environment. Inflation is likely to be here for longer, in our opinion, and you can see here in agricultural commodities versus overall equities. This is agricultural commodities making new highs recently, and this is, basically you can see here that we're now retesting or surpassing the levels that we saw during the Russian invasion. And we believe that overall commodities, which is the blue line, it's really a equal weighted version of the commodities index, is likely to follow on the upside, and that's what also creates that second wave of inflation too. And so, what is the risk in equity markets? I would say the big risk for equity markets really is related to energy stocks, or I should say, uncontrollable inflationary problem. An uncontrollable inflationary problem usually comes to mind in an energy shock, like we saw in the 1970s, like we saw during that stagflationary period when we had the oil embargo period and oil prices surged to new highs, and then it caused a bunch of issues. I think this is a risk for today as well. And when I see that the call options for the implied volatility for call options in the energy space are so cheap, usually I think that's a sign of how investors are just not considering that as a risk, and I think that's a very strong risk. When I look at allocations, because you can think of positioning, capital flows, and allocation overall is such an important aspect to investing. And when you see foreign investors being as fully allocated as they were back in the tech bubble, which is what this chart is showing across U.S. equities allocation, it is concerning. Where's the money going to come from to continue to prop up the valuation of equity markets moving forward? Is certainly a question I ask myself. So what are some of those crazy divergences? Well, here is a fundamental divergence in Microsoft, a mega cap company that has about $3 trillion worth. It's about 2 times the size of the entire energy sector. And then you have Microsoft actually, or I should say the energy sector, generating double the amount of free cash flow than Microsoft. This is kind of a stark divergence. And to me, this is also an opportunity on the energy side, especially at a time when they're not only cheap fundamentally, but we have also investors like Warren Buffett and other smart investors too, entering the space more and more, seeing that there's, and I think that this idea that oil is going to go away and all those things, oil is still a fundamental commodity for the global economy, and will likely be the case for even more than a decade from here. And I believe that this is the energy sector has a long run here ahead of itself. And also, always be aware of the magazine cover curse when magazines come out with very bullish views about the economy. So you got the Barron's bet on the bull, and then the economy's America's pumped up economy, and those are usually times you want to be taking a break from risk. And certainly the no lending narrative has been very prominent in the media, and it is not our view. What we're seeing is very different. We're seeing a lot of issues actually emerging, and valuations seem very disconnected to what we're looking at. And the other thing is copper. I mean, if you think that we're going to go through a manufacturing revamp, this is another way to see how equity markets are expensive, but also copper looks really cheap. And you can see that copper relative to S&P 500 is one of the cheapest levels we've seen in many years. It's a perfect double top, I would say, and it was I'm sorry, double bottom, and therefore why I get really excited about owning copper as well, because I we can see in this chart how much copper was increased in valuation relative to the S&P 500 during the manufacturing revamp of China back in the early 2000s, and how much we're likely to see with the G7 economies manufacturing revamp as well. Lastly, this is another trade that we have it only in the global macro fund, but I really think that it's a very compelling reason to be long credit, to be long or bet on the steepening of the yield curve. I think that the 30-year yields and the 10-year yields both look really expensive, especially for how much we're seeing of the issuances, and also how much we're likely to see in terms of inflation. And I also think that with the Fed actually having to cut interest rates will also impact things like the 2-year yield and so forth. And so we were likely to see the steepening of the yield curve as another way to play the recession. As you can see in this chart, it shows that we usually see a 300 basis points move on the yield spread of the 2 versus 10s. And to be specific here, our funds are actually long the 2-year yield, and or I should say long the 2-year treasury and short the 30-year treasury. And so it's a little bit different than the spread that you're seeing on the screen. All right, I have to go because I actually have to give another presentation here very soon. But I want to thank everybody for watching this, and I'll see you next week. Thank you.
Kevin, it's always hard to follow Tavi because he does such a good job. It's like, gee, now the dumb geologist comes on. But I'll try to at least keep people entertained a little while. Look, we had a project about 2 years ago, and I think a lot of you who watch this video routinely will recall our super secret silver squirrel project. It was our S4 project, also known as, I guess. Look, it resulted in a major investment for us and a phenomenal outcome. Okay. This project took a while. It took about 14 months to conclude, but go to the next slide. We landed an amazing deal. We bought Minera San Cristobal in Bolivia, which is an operating mine. And we've catapulted ourselves. When I say we, it's, Crescat's the biggest shareholder. Okay. And others are involved as well, but it's a very tightly held company that now is one of the biggest. It's private. Yep. You got to come through Crescat or talk to us, talk to Merrick or something. But it is a major producer of silver and base metal. Okay, so if you look at our ranking in comparison to a lot of other silver base metal producers out there, we actually fall number 4 on this list. Okay, last year, 2023, we produced a little over 36 million ounce silver equivalent, I believe, somewhere around there. Of that, about a third of that is actual silver metal. The balance is zinc and lead. Okay, mainly zinc, but also some lead. You can see by the bars here, we fall above Fortuna, Hecla, First Majestic. I mean, this is crazy. We are a private company, but we are one of the biggest in the world. Okay. Now, Pan American, obviously they merged and are probably now more gold focused than they are silver focused. So it's a little bit different. It's kind of apple and orange here. Their bar has extended mainly because that gold production really enhances their overall silver equivalent production. But we're a significant player, and I would say that I would argue that we are one of the more pure players as well in terms of silver. Not pure in the sense of like 100% silver, but we have a very large exposure to raw silver production and revenues. Okay, now while this is great, okay, it's a great position to be. Where do we think this could head? Look, we are anxious to grow San Cristobal. Okay, we're working on projects right now that we see catapulting us up into these upper realms with these other 3 companies that are above us. Okay, we've got a phenomenal project we call the Oxide Silver Project, where a lot of the oxide ores, the stuff that was on the top of the deposit, was stockpiled and is now available for treatment. We can basically, over the course of the next few years, we could potentially build this oxide project and add, say, 10 to 15 million ounces of silver production annually per year. Like this is incredible growth opportunity. We also have a discovery we think could be another San Cristobal. Might take a little while, but once we get it drilled up and we are in a position where we can evaluate the economics and so forth, we think we can build a new deposit. Okay, and that's in addition to what we have right now, right? So I would say over the next 5 to 10 years, we have basically the building blocks to organically build production and be in competition with Fresnillo and Peñoles. That would be my view. Okay, so it's an amazing opportunity. If you want to learn more, please contact Merrick. Please contact us. This is how you would get, exposure to one of the best silver stories in the world. And quite frankly, silver investment opportunities are not all that abundant. Okay, there's like if you look at the fish in the ocean of silver, there's fewer fish in this ocean than say gold and other metals. Okay, so we're definitely one of the bigger fish here, and we anticipate getting bigger and bigger over time. All right, now let's go to the next slide. Now, occasionally we have a meeting down in the corporate office, and Tavi gets pretty worked up. I got to say, he's a funny guy. He's very committed to silver. When he gets worked up, he starts speaking in Portuguese. and he just pounds the table, mais prata, and it's like, what on earth is this guy saying? I looked it up. I did Google Translate on my phone. Turns out he's demanding more silver. Like, he just won't. He can't get enough. It's unbelievable. Anyway, I can make fun of him because he's not here. Okay, go to the next slide. So this time I've decided to call our new project. It's a little different. This is not the Secret Squirrel project anymore. We're going full Monty here. So I call this the Full Monty Silver Project. From here forward, we are out there. We're going to be aggressively pursuing silver because of Tavi and his commitment to this metal. Now, I'm actually kind of a zinc guy. I'll be frank. Okay, I love zinc. Why? Because it's one of the most unloved metals on the periodic table, and we as geologists have forgotten to explore for it. So I think there's a lot of opportunity there. But silver, yes, we're going to be number one. Like, we're going to be the Hunt brothers in a metaphorical sense of silver this next cycle, and that we're going to capture a lot of the silver market. But we'll do it in terms of advancing our understanding of the geology and opportunities for investing that are out there. Okay, so I never noticed this, but on the Full Monty billboard, turns out Tavi was in the movie. I had no idea, but you can see it right there, front and center. Tavi Costa was part of the Full Monty cast, which is a little interesting because I think he was born in the late 1980s, and I think this movie came out in the 1990s. But I don't know. Somehow he managed to pull that off. Let's go to the next slide. Okay, I'm going to go through. I've decided to start today with kind of a basics, a 101 on silver, the silver industry, silver supply, silver demand, all that good stuff. Okay, and most of the material I'm going to present over the next few slides, comes from the Silver Institute publication that comes out yearly. It usually comes out about this time of year. Okay, it hasn't quite come out yet. I expect it to come out maybe in April, I think, is usually when they publish it. So this one here is basically this data that I'm going to show you for the next few slides comes from the report that came out back in 2023. Okay, sometime around April 2023. And I'm going to go over just a few of the basics. I'm not going to pretend I'm, one of these highfalutin, silver guys like Keith Newmeyer or Phil Baker or something like this, where I can get up there and eloquently discuss the virtues of silver and the market for silver and so forth. But I'll try to at least give you guys a little bit of flavor for silver and its place in the world, where it comes from, where it's used, stuff like that. Okay, so this slide basically is a table that breaks down supply and demand in numeric form. Okay, and it goes back about 10 years, so it's looking back to 2014. It does, when this came out, it was a projection of what 2023 would look like. So 2023 is actually forecast in there with a little F next to the number. Okay, but you can see there is basically a deficit that's emerged. It's actually been present now for a while in terms of the silver demand is exceeding the total supply. Okay, now where does silver come from? Look, a lot of it comes from mining, obviously. Okay, you can see, you look at the numbers across that top line. We're producing 800 and some odd million ounces of silver per year. And that should continue, and I'll explain where that silver comes from here in a minute. We also see a significant contribution of silver from recycling. Okay, and what kind of recycling are we talking about? Again, I'll break that down for you in a little bit better detail in the next few slides. There's other minor, but not insignificant sources of silver. You can see net hedging supply, and then net official sector sales account for the balance. Okay, now the demand, industrial demand. Like, silver used to be the photography used to be the driver of silver demand. Well, I mean, like, say in the 1970s and 80s. Now, before that, it was coinage. Okay, silver is actually real money, in my view. I mean, that, like, just hands down, silver, more so than even gold, is money. Okay, we use silver for coinage for eons in human history. It has the properties that are necessary for, for a good, solid foundation for coinage. long as you don't debase it. But you know, it's got wonderful properties that make it suitable for the use as coinage, i.e., money. Now that ended, you know, pretty much worldwide ended in the 1960s. You know, U.S. stopped producing silver coinage, at least, you know, in bulk, you know, like dimes and quarters and such, in 1964, and then many other countries followed suit. So then demand shifted to photography. Okay, but then as photography, you know, the standard, you know, photography with the silver chloride and film diminished, we saw technological uses of silver and industrial uses take over. Okay, and that's where most of the use is today, and that includes brazing, you know, alloys and solders. Talk more about this in a minute. That's a big component of why we have this deficit that we're seeing, because those things like solar cells, for example, so photovoltaic cells, need silver brazing to effectively be constructed. All right. All right, but the takeaway here, we're seeing a deficit. That deficit isn't easy to make up. In fact, you know, as time goes on, that available material that can be recycled and kind of brought in, you know, out of people's, you know, sock drawers and so forth, you know, old coins that grandma might have had or whatever, that's diminishing. It's diminishing through time. We don't have an exact handle on that, you know, how much of that material is out there, but it is diminishing. So that means there's more pressure to produce silver, you know, for mines and such. All right, let's go to the next slide. Okay, so look, I'm a geologist, so I love pictures. This breaks down everything I just talked about, but in pictorial form. So it's much easier to see here. You can see the global supply over here on the left-hand side, and it's driven by the baby blue bars there mainly. So mine production accounts for, you know, 80 some odd % of the silver supply. Recycling is much of the balance. A little bit comes from those other items, hedging and the official sector that I mentioned earlier. Now the silver price, you can see where it's trended. You know, and I would say during the COVID period, there was kind of a particular unique time when there was kind of a you know, strain on supply. You can see the baby blue bars drifted off there, and it was largely driven by, you know, disruptions at mines and stuff, and that really made silver pop, and that's actually very common in the silver market. Why? Because silver is a byproduct. Okay, almost well, much of the silver, I'll show you in a minute, much of the silver we have from mines comes from byproduct of other metal production. All right. So when you see that production get curtailed, base metals in particular, like zinc, lead, and copper, you see the silver production also fall very precipitously. And because of that, you can get a huge spike in silver price. And we saw that, I would say that was a large driver of silver prices in the post GFC period, when there was a contraction in the supply or demand for base metals. The mining of base metals diminished very quickly, and that's, you know, stressed the silver market, the available silver coming out of mines, and silver went on a tear in 2009, 10, and 11. Okay, so that's a very common phenomenon. All right. Now let's look at global recycling by source. Okay, in the middle box there, you can see where we get that recycled silver. And remember, over here on the left, that's just that little kind of teal blue or green bar that's at the top. Okay, but this is like magnified in, and you can actually see where this recycled silver is coming from. A lot of it comes from industrial silver that's recovered. They actually recover silver out of, you know, worn out solders and, you know, brazing on materials that get recycled. You do also see a certain amount recovered from jewelry that's recycled, as well as photography. They actually, when they process, like we still use classical photography and film today even, and when they process the film, that silver chloride that comes off, they recycle that, and that's regurgitated and used in the silver space. And then you see silverware, like old silverware accounts for a lot of the recycled silver, and even coins. Now coins, notice not a lot of coinage, like old coins are used for recycled silver. A little bit, a little bit always dribbling in, but not that much. That's kind of surprising. You would think there'd be a lot more coins. Now, if silver went to $50 tomorrow, this might change. You might see some people open up those sock drawers and coins come flying out, and maybe it's a much more significant component of what's recycled. But right now, it's a very insignificant amount, really. Okay, over here in demand. All right, industrial demand is number one. Okay, that's the gray at the bottom, and that includes all of this, technological use. It's used for various solders and alloys and such. Photovoltaic cells. But you ever look at the cells and you see the little silver lines that kind of are threaded through there like a spider web? That's actually silver solder, brazing silver, alloys that are used to make all of those connections in photovoltaic cells. That's a lot of silver, guys. When you're talking about the increase of use of that, it's not insignificant. And that's actually what's driving the increased demand here recently. All right. Now, a little bit of silver, of course, is always used for jewelry. When I say a little bit, probably about 15, 20% of world silver yearly is used in jewelry, primarily in Asia. Okay, India buys and utilizes a lot of silver for jewelry. But then you also have some actually used for investment, even still. Okay, there was a period, it kind of ebbs and wanes with investment, when people are feeling that silver is probably a good hedge against inflation, stuff like that. You see an increased level of investment interest in silver. When times are stable and stuff, you tend to see a decreased exposure to investment, silver investment. But it is still an important component, perhaps even more so than jewelry on a yearly basis. All right, and then there's a few other items there. There's still manufacture silverware, de-hedging, interestingly. Okay, that's as opposed to the hedging that was over here on the left-hand side. All right, so makes you wonder, who's de-hedging? Look, one thing I've learned about silver market is, and this is just because with operating San Cristobal, I know on a day-to-day basis, we watch the silver price quite closely. Why? Because we produce a lot of silver. On average, we're producing 1.2 ounces per month, monthly basis. Sorry, out of the mine, and it's in these concentrates of zinc and lead. Okay, man, when you got you got 30,000 tons of zinc sitting on the dock in Chile, ready to be shipped, and you have a bunch of silver in there or lead concentrates, whatever. You got to take advantage of price. Okay, so when you see the price tick up in the morning, and you know what I'm talking about. Okay, in the middle of the night, usually silver kind of has a little bit of strength. As soon as New York opens, wham. Anyway, we try to take advantage of that uptick. Okay, so we try to grab the higher silver price as we're shipping concentrates, and everybody does it. Okay, so that all you conspiracy theorists out there, there is a bit of truth to that, and that the people that play in the silver space know that it's a byproduct, and that all of these mines and this concentrate that's getting shipped around the world and stuff, you got to hedge it. When you put it on the boat, you don't want to lose money between where you put it on the boat when it hits a smelter. Okay, you lock in your price then, and if you lock it in the morning, guess what? New York, bam, they knock it down because they know they can short that bit of silver. They can kind of try to squeeze out a little bit of value. So that's actually what causes a lot of the little daily hiccup that we see, and it's just people taking advantage of that particular aspect of the market. Okay, all right, go to the next slide. Go to the next slide. I'm not sure. There it is. Okay, wow. All right, cool. Thank you. Okay, this shows a couple aspects of demand that I think are more and more important. I just clipped these out of the report. The longer term industrial demand, that's coming from photovoltaics in particular is huge. Okay, you can see we're going to see a lot of increase in silver consumption from photovoltaics over time. This is actually pushed out, I think, to 2025 or 6. You can see silver from photovoltaics has grown or is going to grow about 2.5-fold between 2019 and 2026. That's a huge increase, like it's 100 and some odd million ounces of silver per year that extra that's needed. Okay, and then light duty vehicle production. Okay, yes, there's also a slight increase there, but if we go over here to the quarterly vehicle production by powertrain, look, this you can see where the big driver or increase in silver is in that space, in the vehicle space, is in the electric vehicles. Okay, as electric vehicles have started to become produced more and more, we're seeing increased demand in the and this is an index, by the way. It's not ounces, but don't get me wrong. Those are not ounces there, guys. It's an index. But you can see the demand is going up by 3 or 4-fold just over a short period. That's very interesting. If that trend continues, it's all dependent on what happens with electric vehicles. Okay, so, but it is an increased demand. Let's go to the next slide. Okay, well, now where the heck does silver come from? Let's talk about this a little bit. First of all, this table is the top 30 silver producing mines worldwide. San Cristobal is always mislabeled here because they never quite know the numbers. When Sumitomo owned the operation, the data was never publicly shared. Now that we do, we'll try to get this rectified so that our ranking is more properly established here. But we the mine produced about 12.6 million ounces in 2022. I think it was around 12 million ounces last year too. So basically that puts us up at number 8 on this list. Okay, so San Cristobal's 8, and that would move everything else down a wee bit. So it's just a bit of a shuffle of the list here. But otherwise, you can kind of peruse it. If you want to study this list in earnest, go to the Silver Institute site, download the report, or else freeze this video for a few seconds, on the weekend, and you can read through the list of where silver comes from. Surprisingly, a lot of it comes from Poland. Most people don't realize that, but the state Polish mining company, KGHM, produces a lot of silver from the copper as a byproduct of the copper and other base metal production they have in Poland. Okay, so that's actually the biggest individual producer in the world. Okay, now next you have, guess what? Penasquito, which is a gold mine, really belongs to Newmont. Penasquito is in Mexico. It's a big open pit, and along with the gold, they have a significant amount of byproduct silver. Okay, again, byproduct. All right, so you can see it's next on the list, and you can look through like Ducats and so forth. More of a copper thing, but you can see almost all of the mines on here. Not all of them, but almost all of them are mines of other metal, and silver is the byproduct in those cases. And then the map over here, look, I couldn't zoom in on the map and show it all in one picture here, but you can get a sense of where the polka dots are. And much of it is in North America and South America, and there's a few scattered dots elsewhere around the world. You can see Europe, Russia, Asia, and Australasia. Okay, so all right, let's go to the next slide. Okay, top producing companies, and this is just silver. It's not silver equivalent. Okay, but you can see Fresnillo, and then KGHM and Newmont and so forth, like Glencore, and so they're all big silver producers. Now, if you compare San Cristobal on this level, because there's other mines in a lot of these companies, we fall a little bit further down, but on a per mine basis, like I said, we're number 8. But you can see where we're at. We replaced Sumitomo Corp with San Cristobal, and we would actually bump up. I think we're just behind Hecla in terms of pure silver production for 2022. All right, so let's see, mine production by region. This is 2022, but also a forecast for 2023. It's about a little over 800 million ounces, folks. Okay, so that's how much silver is produced worldwide. Now think about that for a minute. It's really interesting. I mean, 842 million ounces more or less last year, and you think, okay, gold, we produce about 100 million ounces, so we only produce about 8.5 times as much silver as we do gold. Yet silver is, like, value-wise, is bugger all compared to gold. That has always been intriguing for a lot of people who study the silver space. The explanation for that is not easily at hand, but it is very interesting. And then, even with the added, recycled silver and so forth, it doesn't account for the deficit, that we were seeing, with demand out there increasing year over year here lately. So it's interesting that silver is $24 and change, and gold's 2,000. But where could it go? Like if the silver or gold to silver ratio, like Tavi mentioned a few minutes ago, right now it's about 90. That's crazy. Okay, that's extremely high in historic perspective. If it were to go back to 40, 50, 60 to 1, silver has a lot of headroom to run. Okay, like silver could truly break out, especially with this increased demand, this deficit and whatnot we're seeing. All right. Now, the image over here on the far right is global mine production per region. And I think it's basically a pictorial representation of the table in the middle. I think this tells you a lot, okay, because you can see right away North America there, steady Eddie, okay, the bottom blue bar. That's where about a quarter, a little bit over a quarter, maybe 30% of the world silver comes from year over year. Now, look at that. You got Central and South America. Now, that's a bit of a roller coaster. The teal blue, if you look, it's dropped way off, and now it's kind of trying to climb back, but it's not really. Okay. Interestingly, the production out of some of the core silver producing regions like Mexico and Peru and stuff has actually diminished, and it will probably continue to diminish unless you see a reinvigoration of investment into those jurisdictions. All right, so that's very interesting because that is like the juggernaut of silver production. Okay, and then next you have Asia. Okay, the orange bars are pretty uniform. A lot of that comes out of China, a lot of it. All right. Then we have, the CIS. Those are the interior Asian countries, or the former Soviet countries. We have a little bit coming from Europe, a little bit from Oceania, and a very, very small amount up at the top from Africa. Very bugger all, basically. Okay, but that gives you a sense of where silver is located, North and South America. Those are the places that I think you're best to look at if you want to invest in this space. Go to the next slide. Okay, this actually gives you numbers on the left of production per country. Okay, now it's up through 2022. We'll see that data updated here shortly. But you're seeing, the breakdown, more clarity here, the granularity of silver production on per country basis. It is interesting to study that. I'm not going to take a lot of time to discuss it right now, but Mexico, Peru, look at Peru. It's dropped off 7 or 8 million ounces there. Mexico's steady between these 2 years, but I think recently it's actually dropped. I think Tavi talks about that in another slide that he has somewhere that I've seen. Okay, there's a lot of those juggernaut countries that are classic silver producers where it's rolled over and it's diminished. All right, some of them are ticking up a little bit, or some of them are ticking up, but they're way down the list. We need more investment in these countries to invigorate that silver production. All right, now the stuff over here on the right-hand side, I've got a table showing where silver is derived in terms of its place as a byproduct of other metal production. Okay, so right away you can see that most silver comes from a byproduct of lead zinc production. All right, so that first column there, lead zinc production, nearly 250 million ounces of silver, which is not quite, but almost a third of all silver, mine silver production comes from lead zinc production. Okay, byproduct. There is some primary silver. Don't get me wrong. There are primary silver deposits. I'll talk about what type those are here in a minute. It produces about 228 million ounces of the total 840 million ounces. Then copper. That's interesting. Where does silver come from in copper production? Well, porphyry deposits often have a gram or 2 or 3 of silver as alongside the copper. And when they produce that copper, the silver often ends up in the concentrates. produced by the copper mine, and then they come out when the material is smelted and the copper is produced. So a lot of copper or a lot of silver is actually generated from as a byproduct from copper mining, and that also includes those sedimentary copper deposits. Like I said, the Kupferschiefer in Poland. There's a fair bit of silver there. All right. Now, an increasing fraction is coming as a byproduct of gold mining. Okay, you're seeing a lot more gold deposits being developed and exploited these days. Yes, they're primary gold deposits, but they have these other metal components with them. And in the case of silver, we're seeing mines like Penasquito, where it's really a gold mine, but there's a lot of silver that comes with it. And so you're seeing an increase of silver production alongside this gold mining that takes place. Now, this data in that table is represented down below in a pictorial sense, okay? The little bars that you see there show you on a yearly basis how much silver comes from each of those subcategories, like how much comes from a byproduct of copper mining, a byproduct of zinc, and then lead. And you can see they broke down zinc and lead there, which is a little confusing, but imagine adding those together. That would give you the lead zinc that we talk about above. Okay, but it gives you a little bit more clarity there. And then look at the gold production or silver from gold production. It increased dramatically. Okay, it jumped way up. Okay, so you can see starting in 2013, there was a rapid acceleration in the amount of silver recovered from operating gold mines. And that's as mines like Penasquito came online and stuff. All right, so that gives you a sense of where silver originates. And again, much of that silver, because it's byproduct and it's produced, it goes into the concentrates that are derived from the mining. And the mining companies have to kind of lock in that price before they ship that concentrate off to a smelter. That's what drives a lot of the market around silver. Okay, and that little New York dip that you see just about every stinking morning is because they know if anybody that's left with some silver orders hanging there, they can knock them down and try to force them to sell at a depressed value. Okay, they're just taking advantage. We try to wake up a little earlier and make sure we lock in the higher price, but it doesn't always work, but we try our best. I think we made like $4 or $5 million last year on just our silver trades, making sure we captured and locked in those higher prices. So it's a meaningful form of revenue for us. But anyway, go to the next slide. Okay, so this shows you in pictorial sense the deposit types from which silver originates. Okay, and I'm not going to give you a lecture on each one of these deposit types. I've talked about these deposits over and over again. Not looking to give you a big geology sermon here, but I'm going to just do a refresh. Porphyry deposits, they're big tonnage, okay? And usually, like if they're a porphyry copper, they're running 0.X% copper, but they might have 1 or 2 or 3 or 4 grams silver in them, and that silver tends to come out in the concentrate. Even though they're not super rich in silver, the volume of material that's being mined there means that little bit of silver that's present will add a significant amount of world production. Okay, CRDs, these are the metals that try to escape from the porphyry. So they're the metals that kind of leave the porphyry center and then go out and they react with the rocks around in various forms. You get structurally hosted ones, you get manto ones that follow the bedding, and you get chimney ones that kind of are like tubes that follow caves and cavities in the host rocks around the porphyry. Those can be very rich in lead zinc, but they can also have a lot of silver. And as you know, many of our investments are CRD type stories that have high silver. I'll touch on those here in a minute. Okay, SEDEX and MVT deposits. First of all, SEDEX deposits are basically sulfide deposits. Think of them like a VMS, but they form at the bottom of the ocean, not necessarily directly associated with volcanism. Okay, they're hot waters moving and circulating through the bottom of the ocean for various reasons. And in this case, you get brines that come up from the ocean floor that have a lot of metal in them. They're basically salt rich, okay, and they can dissolve things like lead and zinc and silver and stuff. And they come up to the seafloor and then they form blanket-like deposits. These can be big. Okay. Sullivan in British Columbia is one. Maronan, that investment we have in Australia, which is part of the greater region of SEDEX deposits down in Mount Isa, trend, Broken Hill and stuff like that. Those are all SEDEX deposits, and they're big. They can be very well endowed with silver. And MVTs, I haven't talked that much about MVTs. It stands for Mississippi Valley type deposits. You can think of them as a version of sedimentary hosted, base metal silver deposits, but they tend to replace limestone. So they're almost kind of like a CRD in a way. They kind of got that flavor, but they're not directly linked to a porphyry. Okay, so they're linked to these submarine or subaqueous fluids that are circulating through the bottom of the ocean or below the seafloor. And that's where you get MVTs. They're kind of take the shape of a CRD, but they're not necessarily related to a porphyry. All right. Okay. Epithermal deposits. Now, this is usually where we get our silver only or kind of, primary silver deposits. You can actually get high grade silver forming in hot spring deposits. Okay. So the one up here in the upper right, that's the epithermal. Those are the epithermal systems. That's where we can get silver rich veins. All right. And they might have other things. They might have a little bit of gold and base metals and stuff. But in terms of revenue, they tend to be the ones that delivers, a high dollar amount for silver. And then you end up with byproduct lead or zinc or gold or whatever, so primary silver deposits. Now, down here in the lower right corner, sedimentary copper deposits. You might say, well, isn't that kind of like a SEDEX deposit? It is in a way, but these are a little bit different. There's a bit different processes going on that form sedimentary copper deposits, usually associated with evaporites and stuff. And I talked about this way, way back when I discussed Hannan metals, I think about 2 or 3 years ago. They're a little bit different, but they're also distinct in terms that they're such a unique category, these sedimentary copper deposits, that I have to bring them up individually, like separate them from SEDEX. Okay, because they're so well endowed, and many people don't realize it, but the biggest endowment of copper on Earth is the Kupferschiefer Basin. I kid you not. Okay, some people think, oh, it's porphyry. It's a porphyry. It's maybe one of these porphyry somewhere. No. Biggest endowment of copper, single endowment of copper is the Kupferschiefer Basin. Other big ones, the African Copper Belt. We have copper up in the Upper Peninsula of Michigan. There's a lot of copper, but there's also almost always silver with that copper. And even though the silver might be kind of lowest grade, like 10, 20, 30, maybe 50, 60 grams silver, when they mine those, man, they can crank out silver. And that's why you see so much silver production coming out of Poland, is because those ores, those copper ores that they're mining, they might grade, 0.8 to 1% copper, but they have 30, 40, 50 grams silver. And man, when you're producing that much copper and you get 10 or 30 grams silver or something out of it, that's a bunch of silver. Okay. So that's where that comes from. Let's go to the next slide. Okay. So here's the full Monty. Now I am not talking about every single, region on Earth right now, but I'm going to tell people on this video, you get to see how I think about this. We're not going to be super secret about this. This is simply looking at strategy about where I see the most prospective areas to invest in silver. All right. And I've taken a map here. You can get it off the internet. It's just a database. And I apologize, I don't have the link for it, but if you search silver mines worldwide on Google, you'll find it right away. It's not necessarily complete. It's just somebody grabbed some data, public available data, and plotted it in a map real quick. So it's not thoroughly, thorough. It's not thoroughly vetted and stuff, but it does give you a sense of where silver mines are. Okay, and then I put circles around, and you can see there's 3 different colors of circles around these clusters. The green ones are areas that I perceive as being favorable places to invest in companies that are exploring for silver. All right, I think they're good places. Why? Because there are operating mines there. There are mines that have been built in recent times, and that was one of the criteria I talked about last week in the video. I'd like to invest in places where I know you can build a mine at the end of the day, right? So the green circles are, we'll call it number 1 priority. Love them, okay? Yellow those are areas where there's a degree of caution that's required before you invest in those areas. Why? Because there's some form of jurisdictional risk. Okay, now some of these areas, like Peru, for example, for a couple of years there, Peru looked pretty bad to invest, but it's improving. I would say that the circle around Peru, which is there, the northern one in South America, I would say that's going to turn green not too far long from now. Okay, but right now it's still got a yellow. I think Argentina and Chile are starting to improve, especially Argentina. So I've converted that to yellow. It used to be red. Okay. Now there's other ones here. Look at Europe for a minute. Okay. A lot of people don't think about Europe as being a place to go find deposits or something to invest. I do. I love Ireland. Absolutely love it. Love Scandinavia. I think it's a great place to invest in mining. But there's also some areas for silver that most people aren't aware of. Okay, Germany and kind of that Central European area is actually historically is a big silver country, right? And I think you're seeing, because the EU is focused on strategic metals more and more, I think you're seeing an openness to developing mines in that region again. So I've turned that to yellow. Southeast Europe, there's a little yellow oval there. Look, a mine Adriatic was open here recently. That's a classic example of an area that probably was off limits for most people in Bosnia, but now is you can build mines. Okay, that's a great thing in my book. Okay, that's a brand new high grade silver mine. Look at Aya down in Morocco, and then even some projects in Spain are moving forward. So if you're discerning, you can see opportunity to invest some in there. Okay, over here in Asia, I've got Southeast Asia. I do think there's a lot of big porphyries there, and they happen to have a fairly significant component of silver. I like them, CRDs as well. Okay, so I think that's a reasonable area to look. Oceania over there to the east of New Guinea, I think that's a reasonable area. Not necessarily number one, but it's an okay jurisdiction. But then there's also places I think you don't want to go. Okay, Mexico. Look, the president needs to stop opening his noise hole and talking about stupid stuff like banning open pit mining and other idiotic things if he really wants people to reinvest in Mexico. Okay, there's beautiful. I mean, that's one of the biggest silver camps in the world. And they've done everything they can to screw it up here in the past few years. He needs to shut up and let people invest and safely invest in Mexico once again. You could see a resurrection of silver investing there once more if they kind of knock off the political rhetoric. Same thing for Central America. Okay, beautiful high grade silver deposits there. Wonderful things. As silver standard. Look over here in Central Asia. I have very little hope that Kazakhstan is ever going to be ground zero for reinvestment, but there are wonderful deposits there. Again, they need to clean up their act. Indonesia needs to clean up its act. Philippines too. All of those places would be exceptional places to invest in silver and other metals if they would just get it together. In the green circles I've talked about, Alaska, the Western U.S., wonderful places. BC and the Yukon, wonderful places. Why do they have a green circle in Ontario, in northern, even Michigan and stuff? Cobalt District, Kuya Silver, lovely camps. Okay, there's beautiful silver opportunities. I probably should have a green circle over New Brunswick and Newfoundland too. Historic silver-rich VMS there. I probably should add that to the list. Okay, Japan. Wow, you crazy? You know what? Silver is actually a very important historically in Japan. There's some world-class silver districts, and I might know a little company that's working on chasing some of those not too distant future. Australia, that Mount Isa, Broken Hill region, big SEDEX deposits. Moronin, big investment for us. These are big silver deposits that most people don't even think about when they think about silver, but it is a silver prolific region. And then lastly, notice the green circle in South America, Bolivia, my favorite place. Okay, it's like going back in time. You can find silver deposits there that are unbelievable. I mean, it's like going back to the 1800s and exploring in an area where there has been virtually no exploration for decades, and there are wonderful opportunities there. All right, so that's the way I think about the world. I'm not doing too many updates. I promise I'll shut up, Kevin, here, but go to the next slide. I am giving a list here of companies, and it's not a thorough list, but it's a companies that we have investments in that have exposure to silver. Now, some of them are as to be expected, byproduct silver. Some of them are private. Okay, anything with an asterisk is private. Okay, San Cristobal Mining. How do you get exposure to? Look at investing in Crescat. Blackjack Silver. What in the world is that? It's an investment in a private company. We have a major stake. We have half of one of the biggest mining districts in the United States under our control, the Butte Mining District. We have a huge resource of silver on the books. We jumped on this one. I'm the chairman of the private company. We have a great team in place. It is one of these things that we work on in the background. And now you get the full Monty, okay? There, you want exposure to big silver, put it to Crescat. Silver 47, that's the one that picked up all those assets that White Rock had, okay, up in Alaska. They're going to be drilling that this year. Look at Magotes. You think, oh, geez, that's that porphyry thing. Quinton talked about a few weeks ago. Porphyries down in Argentina have a lot of silver. Look at Filo, guys, and they're right next to Filo. Okay, so why do I have Magotes on here? Because if they make a big discovery, it's going to have silver in it, and it could be huge. El Oro, yes, duh. That's why I have it in the center there. I want everybody's eyes to fix. El Oro is one of the biggest silver discoveries in recent history. Okay, many, many more here. Barksdale, the CRD in Arizona, Kuya, the Cobalt Ontario story, as well as Bethania, Maronan in Australia. I mean, these just one after another, even ones you might think, well, gee, why is that on the list? Like Hannan Metals? Well, okay, I'm not going over all these. I'm going to shut my noise hole. Let's go to the next slide because I only have one update this week, and guess what it is? Go. Hannan Metals. They put this news release out this week. They announced the discovery of new, thick, high-grade sedimentary-hosted copper in Peru. They've been chasing this stuff for a while, but they kind of looked around and looked at the strata, and they said, you know what? Maybe we should go over here a little ways to the west because the sedimentary strata is thickening in that direction and other geologic reasons. They went off and they found an area 2.3 kilometers long, where they are seeing exceptionally thick beds, like 5.8 meters at 3% copper. Holy cow, but look at there, 65 gram per ton silver. This is huge. Okay, if this turns into, what I hope it is, it could be like a Kupferschiefer of Peru, all right? And they are able to get the drill permits there. Now, Peru has, like I said, they're turning around. They listened to people complaining about not getting drill permits, and now they've opened up the doors. They're processing drill permits faster and faster. This discovery could be a major one. Okay, this could be a major one. I'm very excited about this. This is that Kupferschiefer story that I talked about a few years ago. And sometimes it takes a bit of legwork and thinking and stuff. But boy, when you land on the prize, you know it. Okay, and I think these guys have identified the price here. Now, that's the only update I have this week. Apologize, guys. I've been busy in a one-arm papering this week, but that's it, Kevin.
All right, thanks, Quinton. So you heard about all the incredible silver that we have in our portfolio, and there's a lot, and it's not just the primary silver plays. It's the copper plays with associated silver and the gold stories as well. So if you're interested in learning more and you want some exposure to silver, I think we've got a pretty nice portfolio of it that we believe is incredibly undervalued right now, with gold and silver looking like they're breaking out. I really personally think the timing is really good to be looking at this. We're not making any specific recommendations among these companies. It's not individualized investment advice at all. So we encourage you to reach out to Merrick if you want to learn more, if you want to consider what might be some personalized investment advice for your situation. His contact information's on the screen. So that's all I have for today. We'll see you next week.